If your business is worth 100,000, how much of that do you actually own? Because if you owe money, that number drops fast. That's where equity comes in. Equity is the residual interest in the assets of a business after deducting its liabilities. That might sound a bit technical. Let's make it simple. Residual interest simply means what's left over. So after the business pays all of its obligations, whatever remains belongs to the owner. That remaining portion, that's equity. You'll notice this definition lines up perfectly with the accounting equation. In accounting, everything starts with this relationship. Assets equals liabilities plus equity. Now, if we rearrange this equation, move liabilities to the other side, we get a new form. It would be equity equals assets minus liabilities. And this version is useful because it directly shows how to calculate what belongs to the owner. This is the formula we'll use in all examples moving forward. Let's apply this in a simple example. Imagine a business has assets worth 50,000 and it owes 20,000 in liabilities. Now, pause for a second. What do you think the equity is? It's 30,000, which is 50,000 minus 20,000, because equity is simply what's left after you subtract what you owe. Now, to make this even more intuitive, think of it like buying a house. If your house is worth 300,000, but you still owe the bank 250,000, that means you don't fully own 300,000 worth of value. What you actually own, the equity, is 50,000. So whether it's a business or a house, the idea is exactly the same. Now that you can see how equity works in real situations, let's look at what actually changes it over time. Because equity isn't fixed, it moves, and it's influenced by four main components. These components are what constantly change the owner's claim in the business. And those changes can either increase or decrease equity. It goes up when you invest more, and if the business makes profit. It goes down when the business loses money, or if you take money out. Now let's try to run through that with numbers. Let's start with an equity balance of 10,000. This represents the owner's initial claim in the business. Then, the owner invested another 2,000, and the business earns profit of 7,000. However, the owner also withdraws 2,000 for personal use. What will be the ending balance of the owner's equity? The ending balance of equity is 18,000, which is beginning balance, plus additional investment, plus net income, minus withdrawals. As you can see, equity moves depending on the owner's actions and the performance of the business. Now here's something that surprises many beginners. Can equity actually be negative? And the answer is yes, it can. This happens when a business owes more than it owns. So if liabilities are greater than assets, equity becomes negative. This usually signals financial stress or risk in the business. Let's quickly recap everything. Equity is calculated by deducting liabilities from assets. Hence, equity is what belongs to the owner. And it changes based on additional investment, net income or loss, and withdrawals. If you understand this, then you understand the foundation of accounting ownership. Before you go, just check your understanding. Do you understand what equity is and how it changes after this video? If yes, comment "got it" so I know this made sense. If you're still confused, that's completely fine. You can drop your questions below and I'll be happy to help you out.